Okay, so I'm just gonna go column by column, um, and do this with Excel. I think if you got it right but didn't use the formulas, maybe you'll still learn something. Okay, so ending cumulative earnings, I just take the beginning balance plus the current period, and that will give me how much after I've made this payment to the employees, how much their cumulative earnings will be for the year. So I can just again, in a couple ways, apply this down. I can either drag this corner, or I can go to the cell that has the formula, hold shift, press down arrow to however far I want to go, and do control D. Okay. Um, Now the OASDI limit, I can see that except for this second person who crossed the limit or crossed over the border, everyone else, their entire paycheck is going to be subject to OASDI. So I would do basically this paycheck times 6.2%, 0.062, and I'll just apply it downwards. But again, we know this one is going to need a special calculation. So I'm going to just delete that. Okay, so how should I calculate uh, the OASDI amount for this second person? Well, again, let's just draw this out so we're kind of on the same page. So up until this point, they have earned 145,000. I think 145,200. So we're at this point, and then they're gonna go to 152,400. 152,400. And along the way, they're gonna cross over $147,000 limit. Okay, so this is the total distance they're going, and the total distance is 7,200. So this is 7,200. So I want to know just from here to here, how much is that? It's just simply 147 minus 154, 145, 200. So if I do that math, again, this is equal to 147 minus 145, 200. And whatever that is, this amount is subject to OASDI. All this is not subject to OASDI. So I just want to figure out this amount here. And again, the math is 147,000 minus 145,200, which is, again, this was how much they had earned prior to this paycheck. Okay? Does everyone make sense? Does this make sense? Yeah, Scott.
I'm kind of confused about how you were you and what do you know, you was learning, like how you was writing down.
Oh, like how I did it with the formula?
Yeah.
Okay, so look, this first one you saw how I entered, right? Blue plus red. Okay, let me zoom in a little bit. Okay, so
Plus CA plus B.
so you can blue plus red, right? Which is C8 plus E8.
Okay. We'll talk about it.
Okay, but then you can see in the next cell, it's just moved, it's gone down one. It's shifted both of them down one, right? And the way that you can do that quickly, instead of having to go here and doing this plus this, and then this plus this, there's a faster way to do that in Excel. Okay, you just take this first one, and then you can just do either this corner here. See, it's like it kind of makes a little cross.
Yeah.
You can just drag it down however far you want to go.
Okay.
And Excel is smart enough to know that it's just as it goes down one, the formula, it will shift the cells in the same amount. So it'll just go down one each time.
Okay. Mm,
Okay, so uh, the OSDI amount here is again 147,000 minus this starting amount, and that times 6.2%. Okay, so hopefully everyone got that. Yes, no? Okay. Medicare, no income limit. It's just 1.4, sorry, 0.01. What is it? 4.5? Gosh, I even forgot. 4.
quick question actually on that. That's why are they getting taxed for person who's paying
What was the question?
for one extended month's long life saying
Yeah.
why are they getting taxed less than
Because again, they've been already paying OSDI from 0 through 145,200 on their full paycheck. It's just now they're crossing over that limit, so they're only going to pay OSDI on that incremental amount. But they've been paying over the life of the year, they've paid more because they've earned more, right? It's just now that since OSDI is subject to that limit, they're only paying part of their paycheck.
sweet. Yeah.
It changes every year. It's like 180,000 something now. Yeah, but it's like inflation. And there's some calculation to it, but the IRS determines that every year. Yeah,
What was the formula rest of the OASDIs?
it's just the paycheck amount times 6.2%. If the person had already earned above 147,000 by the start of the pay period, like let's just make up a hypothetical person, it's already earned 155,000. Maybe they're earning 15,000 this pay period. Okay, they would pay zero OASDI because they already are above the limit. They already maxed out their payments in prior pay periods. So at the start of this period, they were already maxed out on OSDI, so they won't pay any of it. Is everyone clear on what this limit means? Yeah. So again, it's only when you start off the pay period below and then you end the pay period over where you have to do this special calculation. If you're below, if you're just below the limit, you're going to pay the full 6.2% on the whole paycheck. If you're above, even at the start of the pay period, you're not going to pay any of it. It's just this crossing of the border that you have to think about how you're going to do it. Okay, makes sense? Okay. Okay, so Medicare is 1.45%, and I just do my formula down like that. We've already given you the information here. Um, because again, income tax is dependent on a number of factors like your filing status, how many dependents you have. You would have filled out some W-4 form, and your income tax withholding would be kind of determined by that calculation. But the book is not making you do that calculation, so it's just kind of giving you those numbers. Um, and then this stuff is kind of arbitrary, so it's just also giving you these numbers. So then the total withholdings is the sum of all this stuff for each employee. OASDI, Medicare, income tax withholding, health insurance premium, optional charitable giving. Okay, and I'll just use the same formula for all of these. Okay, so the net pay is just equal to the gross pay, which is this column E, minus the withholdings. That's going to be your take home pay. Okay. What about the salary and wage expense? What is that? It's kind of a redundant column. Yeah, Mohammed, what do you think? It's the same as what? Exactly. Okay, this is just equal to the gross pay. Okay, so this is kind of a redundant column. It's the same as this. Okay, this is how much you as the employer are paying your workers. Okay, though they're not having all of that in their paycheck, that is how much you're actually like your business is expensing that full amount. Some of it is going to go to the IRS, some of it is going to go to the Social Security Administration on behalf of your employees, but this is the total amount you're actually spending to pay your employee. Okay, so I think I've repeated this like 3, 4 times. Okay, maybe more. I want this to be clear. This is your actual expense as an employer. So I'm just going to do a sum here and then sums for all of these. Oops. Okay. Okay, so now I have all the numbers I'm going to need for my journal entry. Okay, so I'm going to pause it here. To make sure that your journal entries are correct for the salary and wage expense. So we've kind of done number one. I'll give you a minute to make sure your number two you're satisfied with, and then we'll continue on. So just take a minute, try to finish that. Okay, so we have all of the numbers we need here, okay, in these total columns. So what I'm going to do here is we're going to have first the what is the expense? It's called salary and wage expense. We're taking an expense for paying our workers. That's what the whole point of this is. And we know the total. We know it's 19,400. Okay? And the easy first thing to consider is how much am I actually going to pay my workers? Okay? They're actually going to get in their pockets this net pay, 13896. Okay, so I know at least, actually, let's just do this with cell references. This, I know in their pockets they're going to have that much. Okay, and I'm going to call this salaries payable. Salary and wage payable. Okay, it could be cash, but maybe we're not doing our journal entry on the exact day of payday. Okay, so let's just assume that we're going to owe them this money. Okay, now the rest of it, we have a mismatch here. Where's the rest of this expense going? Well, it's going to a bunch of places that the employees owe money to. Okay, number one, the employee owes money to Social Security uh, of total of 186, or sorry, 868. So this is OASDI payable, right? This is a liability for me. I have an expense of this much total. Of that, I have to pay my workers. I'm also going to have to remit some money on their behalf to the Social Security Administration. I'm going to have to pay some to Medicare on the employee's behalf. I'm going to have to pay the IRS on the employee's behalf. I'm going to have to pay Kaiser or Blue Shield or whoever. And I'm going to have to pay whatever charities my employee wanted to contribute to. Okay. So again, this is all money that is like due to my employee, right? Either directly, which is this, or indirectly because I'm paying all this stuff on behalf of my employees. Okay, so I hopefully you're all clear about that now. Okay, all this stuff is uh, uh, part of my expense. It's part of my expense to hire these people, but they owe money to other people that I'm gonna just send the money to directly instead of giving it to the employee and then them paying all these people. I'm just gonna do it for them. Yeah. Tyler. What was that?
No charity is that.
Like,
And grandma and shit.
yeah, I mean that could be, it's not impossible. Yeah, if they set it up as a nonprofit, then there's some tax reason that they did that. Like that, whatever that money goes. Well, they're still going to pay taxes on this full amount that they earned. So I don't know if it'll help them necessarily. But anyways, okay, so let's just complete this. So this is Medicare payable. This is income tax payable.
Oh, is that so?
This is health insurance,
Those,
and this is charity.
yeah, that's not amazing.
Okay. And again, not let's not be confused here. This is not my business's income tax because there will also be a tax expense for my business to put on its income. This is the income tax payable that the employee owes the IRS. Okay, so make sure you're very explicitly clear about that in your head. Okay, is everyone okay? Any questions? Any confusion?
Why are all of the like tax and everything, why are they considered credits and not debits?
Well, they're liabilities. I will have to send this money out to all these people, right? So they're not like this money is not mine. These are all amounts that I owe to other parties, and I'm gonna eventually have to credit cash and clear all these out. Okay. Okay. So any questions on this journal entry? No? Okay. So the next part of this is working with the employer payroll tax. Okay, so we just did salary and wage expense. Now we're going to have a separate employee payroll tax expense. Okay, and this is going to include OASDI, Medicare, SUTA, and FUTA. Okay, we already did the calculation for two of them. OASDI and Medicare, we already did because the employee contributes this much and this much, we as the employer also match that. We contribute the same amount. Okay, so it's like a matching, it's like a 401k, you can think. Okay, so we've already calculated the amounts for that. The Suta and the Futa, there's only one employee here because again, it's only on the first $7,000 of earnings. And you can see that all the employees except for one have already earned over 7,000 by the start of this pay period. So whenever they had started their year of earnings, they had already paid Suta and Futa, or we as the employer had already paid it. We only owe it for one employee who looks like it's a new employee. So they haven't yet earned $7,000 from us during the year. Okay. So don't think that the other employees got away with it or I, as the employer, didn't have to pay for them. I just already did it at the start of the year. Okay. Because you can see their starting earnings is above 7,000. These employees have, this is probably late in the year, this whatever this paycheck is. Okay. So take another minute, see if you can figure out those amounts, and then we'll do it together. Do this. So again, Futa and Suta are two of them. The other one is OASDI and Medicare. And the Medicare and the OASDI, again, are easy because they're just matching amounts to what the employee pays. And again, what is this? This is for employer payroll tax expense. So again, to pay your employees, this is again why a lot of employers like to have like contractors, okay? Because they only will have this expense for contractors, however much wages they're paying them, okay? They are like not wages, whatever the contract rate. This employer payroll tax is for who you have on your payroll, okay? So this is an extra expense that an employer has to pay in addition to what they're compensating the worker. Okay, so again, this is now maybe you'll understand about the games that like businesses will play with contractors. Okay, now contractors oftentimes are okay with it because the employer will be like, well, since I'm saving on payroll tax, I'll pay you a higher wage, right? Because they know that they're saving from not having to pay the payroll tax. So you as a contractor could potentially earn more, uh, but you're also not contributing to your social security. There's some downsides with that too. Okay, and oftentimes an employer will also give benefits to a full-time employee that they don't to a contractor. So there's some trade-off, right? A lot of travel nurses, for example, they earn a ton, right? Because they're contractors. They don't get any healthcare benefits, they don't get anything, but they earn a very high wage, right? And then they'll just pay they've worked it out, so they just pay, health insurance out of their own pocket. But the hospital or whoever employs them pays them more because they don't have all the extra healthcare, payroll tax, all the extra stuff. So they end up paying them a higher wage. Okay, so Futan Suta, again, we determined that there's only one employee who is earning less than seven, or who has earned less than 7,000, and it's this person here. And so this $2,000 is subject to futa and suta. Um, and if they got paid 2,000 in the next period, that's also going to be subject to futa and suta. In the next pay period, if they made 2,000, because they're at 6,000 at that point, and the next pay period after that, where they earn 2,000, only half of it would be, right? Because they're going to go from 6,000 to 8,000. So they'll have crossed over that border. Okay. So the crossing over these limit borders, that pay period, there's always going to be some special calculation. Okay. Okay. So anyways, how do we do this? So we do 2,000 times 0.006, not 0.06. 0.06 is 6%. This is 0.6%. And then 2,000 times 0.054. Okay? And then the total expense is just a sum of all this stuff. Okay? So to have my employees, I paid this much as their compensation, and then an additional 1,300 almost for payroll tax. Okay? Okay, so now when we pay all this stuff off, okay, now we have all these payables. And just to remind you, I think I mentioned this, salary, or sorry, OASDI payable. What is the total amount in there? How many journal entries were affected by it? We have this one here, and we have this one here. So remember, there's two of these, 868, 868. And so the total is going to be this plus this. Okay, so now when you're paying the cash out, right, that's what this next journal entry is. Make sure you have the correct amounts for all the payables. And really, there's only two of them that are a little tricky. Okay, so take a minute, make sure you can do the cash journal entry where you're paying out. I think, what is it asking you to do? First, it says payment to the employees. Okay, so one is when you write all the paychecks for the take-home pay. There's gonna be one journal entry for that, and then there's gonna be one where you pay off the withholdings and employer payroll tax. Okay, so there will be two different journal entries that you got to do now. Okay, so take a couple minutes, see if you can figure out what that is. Okay, so let's finish this off. Okay, well, let's look at all the payables we have here. I have all of these. I'm just gonna copy and paste these. And then in addition, what do I have? OSDI and Medicare are already here. Sorry, actually, the first journal entry is just the salary and wage payable. So actually, I'm just going to copy these here, get rid of these. So salary and wage payable I'm going to have to debit to get rid of it. And the amount is 13,869.96. So what should I credit? What account? Cash. Exactly. Now this is going to be in the form of, how many employees did I have? I think 6. This is going to be 5 checks, right? And the respective amounts are this, 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 this. But the total amount of cash that is going out is 13,896. Okay? So that's the first one. This is on payday, or whatever my payday is. Now, for paying off all these payables, I should have actually, oops, they're all going to be debits. What have I not included? So I have OSDI, Medicare, income tax, health insurance, charity. In this one, I have OSDI and Medicare, so I've already included those two. And then I just have these additional 2. Okay, and then the amounts, again, OSDI is going to be this, which is 2 times 868. Medicare is going to be this 281. I'm just going to do times 2. Because you can see again, it's like matched here for the employee payroll. Okay, so I have these 2. Oops. Income tax, I'm just going to get from here. And then I'm just going to apply these 2 downwards, okay, because it's the same. You can see here, health insurance, charity, charity. Okay, so now I have all the amounts from that first salary and wage expense journal entry, and then futa is here, suta is here. Okay, so now I have all of these uh, payables that I'm debiting. They're all going to be paid off, and I'm going to pay everything off with cash. Okay. Now remember, all of these are different checks, right? OSDI and Medicare is going to go, one check is going to be for the sum of these, which is 2,299. That's going to go to the Social Security Administration. Income tax payable, that's going to go to the IRS. That's going to be a separate check. Health insurance payable, this is going to be a check to Blue Shield, whoever. Charity payable, that's going to be to, United Way or whoever. Futa and Suta, this is going to go to the EDD. It's the state, that department that manages the unemployment insurance. Okay, so though this will be like 5 different checks, it's all going to be cash. It's going to be this amount total is how much is going to leave my bank account, split across these 5 different checks. That make sense? Yeah? Okay. All right. So, any last questions on this payroll? Like, this is definitely the the hardest question on your homework. Okay, but we kind of just did it in class together, so I expect all of you should be able to do it now. Okay. All right. So why don't we take a couple minutes and we will just wrap up the chapter. So we'll start up in like 5 minutes. So go ahead and take a break. All right. Okay, so the last like miscellaneous topics in the chapter, um, internal controls. Again, we talked about this in chapter 7, but payroll is also a very sensitive area of fraud and potential mistakes. So there's a bunch of stuff. Again, when you're thinking about internal controls, it's good to kind of think like a scammer, because then as a business owner can protect yourself. Okay, so there are a bunch of common scams or whatever mistakes that can happen with payroll. Uh, buddy punching. So this is like when someone clocks in for you and you're not there. So the employer ends up paying you for hours that you actually didn't work. Okay, so this is like, what are some like modern ways that employers now protect against this? Does anyone know? Does anyone have to clock into a job?
I know that in some workplaces, I've worked in a place before where you had to do this with fingerprint.
Exactly, exactly. So biometrics, right? You have to physically be at some machine to clock in, right? So that's an internal control. The business had to spend money to get that special kind of clocking in machine. If they could trust the employees, you could just do it on a piece of paper, but employees be scamming. And a business has to invest in internal controls, and one way is um, biometric kind of timekeeping. Adding timesheets. So you just add extra time to a timesheet. Okay. So, one way, again, a business will do this is biometrics, or they'll, there has to be some, video cameras. There's a lot of things that an employer can do based on what their business is, and, what the potential areas that an employee could do this. But, this is a common one. Commission and bonus schemes. Okay. So if a worker is paid by a percentage of sales, they can do various things to pad their sales numbers, right? So again, this is um, especially for like, yeah, there's certain businesses where this is a much bigger issue. Okay. So um, ghost employees. So this is one where someone in the accounting department can be scheming. Okay. So you can create a fake employee, or like list your buddy that doesn't actually work there, use their social security number, add them to the payroll system, and they're going to get paid, right? The common one that has been in the news a lot is like your business or your non, this is happening a lot in nonprofits where the nonprofit pays the business of their spouse or someone else, like some amount, for not really doing much, if anything. So just paying fake work, because what is an NGO? How do they get paid? It's based on their expenses. Okay, so oftentimes they will pad their expenses with payments to related parties, and increase their funding ask, because they have this larger budget. Okay, um, pay rate alteration. Okay, so again, this is if you have access to the accounting system or the HR system, you can just change yourself from a $25 an hour to a $55 an hour worker. Okay, so these two are limited to people that have access to the accounting system. Okay, you need to be able to manipulate how the calculation is done to pull these off. And then expense reimbursement fraud. Okay, this is a common one too, where an employee will spend a bunch of stuff on their personal, um, kind of their personal needs, and then expense the company. And we saw that with the Jacksonville Jaguars guy, right, who was buying country club membership and gambling and all that kind of stuff. I have a friend who works at a company, not to be named, but they're running a scam, not a scam. I mean, it's tax avoidance. Okay. That's mutually beneficial to the company and to the employee. What the employee will do is basically go to Costco or whatever, use the company card to expense their own personal items. And this is in lieu of a bonus being paid. Now, why is this a win-win? Number one, the business can expense all those items in its own taxes to reduce its taxable income. Secondly, the employee benefits because they're getting the value of that bonus, but they're not paying any payroll tax, and they're not paying any income tax on it. Okay. And my friend who is like stepped in as kind of the accountant, he's like, I'm not going to sign off on this. And he's like, if you're going to do this, I don't want to know about it, you know? But it is illegal. This is highly illegal. It's tax fraud. Okay. So, and the owners of the company are cool with it because they're just like, they feel like the risk of getting caught is low, um, which is probably true, but it's still tax fraud. Okay. Um, So it's not just the employee necessarily scamming the company. It could be a mutually beneficial thing because the again the in this case the employer was happy with it because the employee did earn a bonus that they needed to pay them, right? So it's just how they're paying it is like fraudulent, you know. If you're paying a cash bonus, it's going to be subject to payroll tax, withholdings, all that stuff, and so they're just trying to skirt around that. It's the same thing of like if you pay a business cash, right? Like a nail salon. I don't want to hate on nail salons or, like a mechanic. I've paid, my mechanic has asked for cash, you know. Why do they want cash? Because they cannot report it on their taxes. So there's a lot of tax things that happen for small businesses to kind of minimize their tax liability, which of course is not legal. Okay, so um, what are some internal controls? Again, automation of payroll calculations. Okay, so if you have it all in an Excel spreadsheet and that's how your payroll is calculated, there's like definitely for mistakes, there's a ton of room for that. Also for just like someone going in and altering things. Okay, it's hard to audit an Excel spreadsheet unless you're like the only person that can open it. Okay, if it's shared with a team of people, it's like it's going to be hard to control what changes are made. That's why there's a lot of software like QuickBooks. There's specialized payroll software where there's much less room for manipulating the calculation. Okay, because it's kind of done within embedded in the software. So the employee only the accountant only has certain things that they can change. Timekeeping, again, biometrics and using multi-factor authentication, etc. Um, hiring, firing. Uh, that function of hiring and firing is separate from payroll and accounting. That way you have like this ghost employee. It's harder to do if the hiring and firing is separate from the accounting function. You'll have to have collusion between the two. Um, direct deposit to employee's bank account instead of checks because checks can be, that's like a risk in itself, like checks being forged and there's different fraud you can do with checks. And then manager sign off of reimbursements. Now again, that Jacksonville Jaguars, right? If there was some oversight of spend on those credit cards, then that guy probably not would not have been able to spend that whatever it was, $20 million. Okay. Okay, so this is all internal controls. Any questions on this or comments? No? Okay. Okay, so the other topic that's covered kind of in the chapter is liabilities that are based on estimates. Okay, so what are some, so again, some liabilities, you don't know the exact dollar amount. Okay, so when you borrow from a bank or you have an account payable for inventory you bought, you know the exact amount you owe. Some liabilities, you don't know that. Okay, you have to estimate that. It's similar to what we did with accounts receivable and estimating how much we would have to write off. What was our allowance for bad debt, right? This is a similar thing. What are some examples? A bonus plan. Bonuses are based on future sales results, so you don't know exactly how much bonus you're gonna have to pay, or how much is accruing over the year, because you don't know the exact amount you're gonna have in sales. Vacation, because you don't know how much vacation time employees are actually going to take. You're paying them and you're allocating vacation time, but how much they actually take, you don't know. Um, health and pension. So this is all based on future deaths, when a person is actually going to die. Healthcare costs. How much is it going to how much is it going to take to put someone in the hospital for a week 20 years from now, right? You can't, it's going to be based on some estimate. You don't know what that actual number is. And then warranty. Okay, you don't know, you have some sense of how many of your products will go bad, but you don't know the exact amount. Okay, so all of these are examples of liabilities that are real, but you just don't know the exact dollar amount because it's based on some unknowable future event. And the best you can do is use estimates and some methodology to estimate what these things are going to be. Okay. Um, so this is a question in the homework and in the book. It's not quite based on an estimate. It's more algebra. Okay. So I'm just going to put this up here. Um, see if you can figure it out. I'll give you a hint. There's multiple, like you probably learned this in Algebra 2 trig, where you have uh, two different variables and two equations, and you got to solve. Okay, so that's the hint I'll give you. See if you can figure out what it is. Okay, so you're gonna have to set up. There's two unknown variables in here, but you'll have two equations that you can also set up, and that way you'll be able to solve for both those variables. Okay, so that's the hint I'll give. See if you can figure it out. Okay, does someone want to walk through it? Is someone confident about their methodology? Yeah, Tyler.
Can I just explain the formula?
Yeah, sure.
The bonus percentage times the net income before the bonus divided by 1 plus the bonus percentage.
Okay, so what were your two equations? How about that? Let's like set it up because it sounds like you got to the right answer, but how did you get there? What were the two equations?
5% times 15,000.
5%. Okay. 5%. Okay.
And 1 plus.
What does this equal?
Oh,
Actually, okay, yeah. So you're giving me your answer. Is that what you're telling me?
yeah.
Okay, so what is it? 5% times 315.
And then that parentheses and divide by 1 plus 5%.
Okay, what was the dollar amount you got?
15,000.
15K. Okay, that sounds right, but let's do it a little bit systematically because you must have done it somewhat systematically, but you tell me if you did it this way. So there's two equations, okay? 5% of our net income is going to be the bonus. So the bonus equals 5% times NI. Okay, there's two variables and only one equation so far. So we can't solve this yet. Okay, we need another equation. And what we can do is look at this second statement. 315 minus the bonus equals net income. Does everyone agree with these two? I've just translated what those words said into two equations. Does it make sense? Okay, so now we have two equations and two unknowns, so we can solve. Okay, so what I could do is substitute. I already have b written as a function of net income here, so I can just substitute it here. I can do 315 minus 0.05 times net income equals net income. And then I can 315 equals net income plus 0.05 net income. I just added net income to both sides. It canceled with this. And then I factor out net income. So 315 equals net income times 1 plus 0.05. And then take this and I can do 315K divided by 1 point plus 0.05 equals net income. Okay? So what is this equal to? Let's see. 315 divided by 1.05. 300 equals net income. Okay. So now if I want to know what the bonus is, I can just go back to my original equation here. Bonus equals 5% times net income. So 300K times 5% equals 15K. So yes, you got to the right number. Okay. So yeah, this is a little bit of algebra. Throw back to algebra 2 whenever you took that. Okay, but it's, I think once you see it, hopefully it refreshes your memory. Okay, any questions on this? Anything need to be clarified? You can take a picture. Actually, I think this one is probably written in a nicer manner. So you can take a picture of this if you want to just remember. Okay, and this would be, of course, the journal entry. Okay. The hard part was calculating this amount. That's really the difficulty. After that, the bonus expense is this, and you're gonna have to pay it out to them. Okay, everyone good with this bonus thing? Okay. Okay, next one. Company made sales on account of 50,000. Cost of goods sold is 35,000. So this is the revenue. This is the cost of goods sold. Subject to product warranties. Okay, so this is on June 10th. Uh, and you estimate that the warranty will be 3% of sales. So basically, what is the adjusting entry? Let's say December 31st. What's the journal entry for warranty? And I'll give you a hint, warranty expense. Okay, because again, some of these sales are going to come back. They're going to get returned because the warranty. Are you going to have to? There's going to be some expense associated. Okay, so you want to make sure that you're matching the cost of the warranty with the revenue because they should be in the same period. Okay, so there will be an adjusting entry. So think about what that's going to be. Okay, I don't think it's too complicated. Anyone have any ideas? What are the accounts that are going to be involved? Yeah. Okay. Yeah. Warranty expense and warranty payable. I agree with that. And then how did you get the amount?
3% times 3,000.
Yeah, I think it's going to be the 3% of sales. I think that's of revenue. Yeah. So I think it's going to be, um, so this would have been the journal entry and then it's 3% of the sale, like the revenue. Yeah. Um, so actually this should have been December 31st. You're probably going to take this um, as an adjusting entry. Okay. Um, yeah, the point is that you're going to have some expense for warranty and you're going to have some liability that's going to be kind of as you pay out warranties. So like let's say in the next year you pay a warranty like claim. What's going to be the journal entry for that? What do you think? Should we take an expense again? Because we have to pay the person out cash. Let's say it's like a return, right? The thing is defective. So you're going to have cash. Let's say it was $100 return, the item. So what should I debit? Should I do warranty expense here? No, what should I do? Exactly. So we'll use this estimated warranty payable as again a little piggy bank. Okay. And it's possible that this credit balance gets used up and becomes a debit balance because we have more warranty uh, claims than we estimated. And you'll have to fix that. In the next period, you'll have to take a larger expense for warranty. to make up for that. But remember, I told you that story of what's it called? Um, Tesla, where they were selling more cars, but they were not taking a larger warranty expense, and they were doing that for the short term because they needed to be included in the S&P 500, and they needed to show a positive net income, and they barely did during those quarters. Once they were in the index, they're going to pay the price because there will be more warranties that come in because they're just selling more cars, but they'll just take a larger expense later because the goal at that time was just to show positive net income for those few quarters because they needed that to get into the S&P 500. Okay, but it was all deferred. It's not like they were getting a free lunch. They were going to have to make up for it later by having lower net income. Okay. Um, yeah, so I think we just talked about this. In this case, instead of uh, paying out cash, we just replace the item, right? So with a warranty claim, it could have been cash, where you just refund the customer with money, or you would just replace the item, and that would also be a credit to inventory because you're kind of giving up this inventory item to the customer to replace the one that they made a claim on. Okay, so you have to read what how you settled the warranty claim. Okay, it could have been with cash or with a replacement, and you have to credit accordingly. Everyone good with that? Yeah? Okay. Okay, so the next topic that is covered in the chapter is contingent liabilities. So this is a liability that's not actually there yet because it's based on the happening of some other event. Okay, so a lawsuit is like the classic contingent liability where you're only going to have a liability. You're only going to owe someone money if you lose a lawsuit. Okay, so that's that the lawsuit claim payable is only going to happen if you lose the lawsuit. Okay, so a warranty you can say is also contingent. It's contingent on something breaking. Okay, we're going to take an expense for it because we know that things break. A lawsuit is a little more discrete, right? You don't like lawsuits are discrete events, right? A warranty, if you're selling a lot of products, you just statistically know some of them will be bad, and so you can take an expense for it. But a lawsuit is going to be dependent on like what lawsuits are actually happening in your business. A guarantee, okay, so this is a common one in real estate. Uh, a investor is going to set up some LLC. Let's just say LLC, and then the LLC is going to own some building. Okay. Now, the bank, if they needed to finance the purchase of the building, the bank, where is it? The bank, they're going to technically lend to the LLC because the LLC is the thing that owns the building. However, the bank knows that there's only one asset in this LLC, and they may ask this person to provide a guarantee to the loan, meaning that let's say the loan goes bad. If the bank sells this, let's say the loan was for 10 million, if they were only able to sell the building for 8 million, that $2 million deficiency, if this person is given a guarantee, they're going to have to come up with it. Okay? So it's a contingent liability in that it's contingent on there being some deficiency. Okay? If the building sold for 18 million, then the bank would get all their money back, right? And the guarantee would no longer be relevant. So it's only if number one, the loan goes bad, and number two, the asset that is secured by the loan is not sufficient to pay off the loan. Okay, um, so this is bankrupted a lot of real estate owners, investors. Okay, they give guarantees expecting nothing's going to happen, but when it comes down to it, they can lose everything. I actually know a guy. He was a tech guy, and he started in the real estate kind of investing game, kind of when I did, and he made a lot. He like grew his business into like a really big, like large scale, like apartment building developments. but he was giving personal guarantees on all the loans, and things just turned. I think this was like, I don't know if it was during COVID. I think it was after COVID, maybe. Um, but basically, he lost everything. He lost all his personal assets, and of course, the paper gains that he had on all the development projects. So these guarantees can really, really burn you. Okay, people go to zero over it when they're old, um, because you don't expect things to all your things to go bad at the same time. But actually, in real estate, and even like stock market and stuff, things that's the correlation is quite high, higher than people think. Okay, and then investigations. This is probably related to lawsuits. Okay, so how businesses record, okay, these contingent liabilities, it's going to depend on the likelihood that it's going to actually become a liability. So, and this is a little, there's like leeway that management has because they're going to determine these probabilities. So if they determine that it's a remote possibility that there's going to be a contingent liability, there's no disclosure. You don't have to write about it in your financial statements at all. And of course, there's no journal entry because it's not a likely thing that's going to happen. If it's reasonably possible, okay, then you just have to disclose it in the notes. You'll have in the financial statements of like public companies, they'll have a whole section devoted to like lawsuits, for example. So you would write, "Hey, we're being sued by this person, and it's reasonably possible that we could lose and be subject to some $10 million lawsuit or $50 million, whatever it is." Okay. Um, there's no journal entry though, because again, it's not yet a transaction. Nothing's actually happened. Okay. Now, the last one is if it's probable. Okay. If it's probable, you'll have to disclose that for sure. And the crazy thing is, if you don't know the amount of it, and you can't reasonably estimate how much the liability is going to be, you don't have to do a journal entry. You just have to disclose, hey, we're probably going to lose this lawsuit. We don't know exactly how much it's going to be, and it's not actually going to be reflected on the financial statements, like on the balance sheet. If you can't reasonably estimate how much it's going to be. If you can, then you will have to have a journal entry that says, lawsuit expense, whatever, 100 million, and lawsuit payable. Lawsuit claim payable. It's unpayable because you haven't actually lost the case yet. You're probably going to lose it. But at this time, if you really determine you're probably going to lose, you have to take this expense. And that's going to impact your income statement, your profitability. And of course, you're going to have this liability that you'll have to pay at some point. Okay, makes sense? Um, I've never actually had to deal with this, but I would assume that if you're probably going to lose a lawsuit, your auditor is going to really push you to estimate the amount. I don't think it's like very common where you'll have a probable situation where you're going to lose a lawsuit, but you don't actually do a journal entry. It's like that's going to be pretty shady. It probably has to be a really specific case to allow that. If you're probably going to lose, you're going to take an expense for it. Even if it's not the best estimate, you'll probably be pushed to make some estimate. Okay, so we'll end the class with the problem, but let me just finish off the lecture so we don't have to come back to this. Okay, so the ratio at the end of the chapter is this interest coverage ratio. And again, what it's trying to answer is how able is your company to be able to pay back debt? Okay. So again, this payment of debt is a key theme for a lot of these ratios because that's such an important and critical question to answer, both as if you're a lender to the business, of course you're going to care about that, but also if you're the owner of the business because your equity is going to get wiped out potentially if you're not able to pay off your debts, right? That's when a company goes into bankruptcy. Um, So what this ratio is trying to answer is how much income is there to support interest payments. Okay. So it's like if you have credit card debt of say $10,000, who do you feel better about if you had to lend another 10,000? Would you feel better about lending to someone who has uh, $500,000 in earnings per year, or someone that earns $40,000 a year? Who is the better person that you're going to lend to, given that each have $10,000 in debt? It's obvious, right? Hopefully. Yes, the person who earns more, there's going to be more coverage of the debt, right? They're earning a lot more. They're much more able to service the debt if you're earning more. Okay, so that's what this ratio is trying to figure out. Now you're going to add back certain things. You're going to start with net income. You can see here, but you're adding back tax and you're adding back interest expense, because you can think about it like this. You're going to have your revenues, you're going to have your operating expenses. Okay, so let's say this is 1,000, this is 400. That means your operating income is 600. This is how much your business generates. From this, you're going to pay first interest expense. Let's say it's 50. Now, interest is tax deductible. Okay, so your tax expense is based on this. It's based not on your operating income, but it's based on how much you earn after paying off your interest. Okay? And then you're going to have your tax expense. Let's say it's another 10. This gives you your net income. So what we care about is not your net income. We care about how much money you have to pay your interest. So we're going to go back to here by adding this. And then we're going to go back to here by adding this. Make sense? Okay, so that's what this is. So you start with your net income, you add back income tax, and you add back interest expense. And that gives you the pool of money available to service your debt. And then you divide that by how much interest you have. So you can see here, we have $600, and that pool is available to pay this $50 of interest. So it's a quite high ratio, 600 divided by 50. So what is this, 12? 12x? So if you're a lender, you're going to feel quite comfortable uh, giving another loan, at least on an interest expense basis. Okay, this is not capturing how much principal, right? You're borrowing, because let's say this interest expense is, they've somehow during COVID they were able to borrow, and they have this is 1%, so times 100, so 500, 5,000. So this is on $5,000 times 1%. Okay, this amount is a lot compared to this 600, right? So on a principal, how much principal balance they have, maybe you're going to be like, I don't like that. But we had another ratio for that. We had the debt ratio, right? That's going to capture that question of how much total debt do they have um, compared to their assets. That's going to answer that indebtedness question in a different way. This is just looking at how much cash flow to keep the debt out of default, right? And that's going to be dependent on both the amount and the interest rate that you're paying. Okay, so you have to understand this question of indebtedness in various perspectives, both from a total indebtedness perspective and from a cash flow, being able to pay the debt and make sure it's not going into default perspective. Those are both important questions to answer. Okay, everyone clear on this? Hopefully. Okay. All right. So let's just work on this other problem, 11-38B. Um, it's going to give you some practice with these uh, estimated liabilities and these contingent liabilities. It's going to give you different transactions and ask you to do journal entries. So we can open that up. You can see here there is 5 transactions. Um, And so now you can apply what we just talked about and see if you can figure out what the journal entries are. So why don't we work on this, and maybe in the last 5, 7 minutes of class, we'll just do it together. Okay, so the first one, you're party to a patent lawsuit infringement, and the attorney is certain it is remote that we will lose, or this company will lose. So we don't got to do nothing, okay? If it's a remote possibility, no disclosure, no journal entry, nothing, okay? Okay, so second one, we estimate that warranty expense at 3% of sales of 430,000. Okay, so this is kind of like a middle of the year adjusting entry. Okay, maybe we're ending the period. We have semi-annual financial statements, so we have a warranty expense that we're going to take at 3% of the sales. So we'll do warranty expense and then estimated warranty payable. And this is on June 30th. And it's going to be 0.03 times 430,000. Is that right? 3% of sales. What the heck? Okay, anyways, let's continue on. I think I had some wrong. Let me see here. Okay, actually, sorry. Okay, all right, so let's continue. July 28th, we paid warranty claims, 6,400. So again, we talked about how we do this before. We're not going to take the warranty expense again. We're just going to kind of uh, draw down this estimated warranty payable. And did it say how we're claiming this? We paid. Okay, so I'm going to assume it's cash. Okay, and hopefully on your homework or whatever, it's going to be more clear about exactly how you settled the warranty claim. Okay, but it says paid, so we'll just assume that it's paid in cash. Okay, we're now subject to another lawsuit. Gosh, this is companies, doing some shady stuff maybe. But we're in another lawsuit for a copyright violation, 130,000, and it's probable that we're going to lose. We estimate the loss at 130,000. So we're going to have to do a journal entry for this. So we can call it, I don't know, lawsuit. Um, it's going to be some kind of expense, okay? So we can call it lawsuit expense, and then it's going to be like estimated lawsuit claim payable, something like that. Okay. So, but the point is that you're going to have to hit your income statement and therefore your equity, right? Your owners are not going to be happy about this because in the end, this is an expense that's reducing retained earnings, which is reducing the value of equity in the business. Okay, so this is like bad for your owners. Um, so the date for this was what? September 30th. The date for this was July 28th. Okay, and then finally we have at the end of the year we take another Uh, warranty expense. So it's going to be basically the same thing as this. But now we have a different amount of sales for the second half of the year, so 510,000. And this is again at the end of the year. Okay, so yeah, so I guess it told us that we have a beginning balance of 0. So we had 0 balance here. We had a credit here, 12,900. We had a debit here, 6,400. And then we had another credit here of 15,300. So the total is going to be this plus this minus this. This is our ending balance. So you can see here were we overly aggressive or conservative in our estimation of warranty in the first half of the year at least? What do you think? Who votes that we were like conservative in reserving for a warranty?
Reserving for warranty.
Yes. Yes, we were, right? Because we took an adjusting entry expecting $12,900 of warranty, but only like half of that amount actually came in, right? So we took a large expense, right? We took a larger than necessary expense. So maybe there's a reason for that. Maybe it's a long tail, right? Maybe the warranty was for 2 years, right? So really, this expense is for a tail of claims that is going to last for 2 years. And some of it came in now, but some of it's going to trickle in the future. Okay. So it's unclear. It really depends on the length of the warranty and how quickly you know if your product is defective or not. So we don't have a definitive answer yet, actually. Okay. But if it was like for just a 6-month warranty or a 2-month warranty, it was conservative because we had less claims come in. Okay, so we don't know enough to really say yet. All right, any questions on this? No? Okay. All right, so that's it. Don't forget we have